Bitcoin was built as an escape, not just from inflation, not just from banks, but from a system many believed was fundamentally rigged. In 2009, in the shadow of the global financial crisis, trust in institutions collapsed. Governments bailed out banks. Central banks expanded balance sheets. Ordinary savers paid the price through unemployment, foreclosures, and currency dilution. Out of that chaos, Bitcoin emerged. A peer-to-peer monetary system, no central authority, no bailouts, no gatekeepers. The first block mined carried a message referencing bank rescues, a time-stamped protest embedded permanently into the code. It was more than software. It was a reaction. Bitcoin promised sovereignty. If you held the keys, you held the money. No intermediary could freeze it. No institution could dilute it. No central banker could vote to change its supply. 21 million coins, fixed forever. That fixed supply was the rebellion. For years, Bitcoin lived outside the financial establishment. It was dismissed as a toy, then ridiculed as a scam. Early adopters were technologists, libertarians, cypherpunks, not hedge funds or pension managers. Wall Street ignored it until it couldn't. As Bitcoin's price climbed from dollars to hundreds, then thousands, something shifted. What began as ideological resistance became financial opportunity. Capital does not care about origin stories. It cares about volatility, growth, and asymmetric upside. Institutions began watching. The first step was derivatives. When Bitcoin futures launched on major exchanges, it marked a turning point. For the first time, large financial players could gain exposure without touching the underlying asset. They did not need wallets. They did not need private keys. They did not need to leave the regulated ecosystem. Bitcoin entered the system it was designed to bypass. Then came custody. Large financial institutions built regulated custody solutions. Coins moved from self-sovereign wallets into institutional vaults. Security improved, but concentration increased. The mantra, not your keys, not your coins, slowly lost dominance as convenience overtook ideology. Then came the ETFs. Spot Bitcoin exchange-traded funds allowed anyone with a brokerage account to gain exposure. Retirement accounts could allocate. Pension funds could participate. Wealth managers could recommend it. Bitcoin became a ticker symbol. This was the moment the cage began forming. Not because the protocol changed, not because the supply cap was altered, but because the price discovery mechanism shifted. Originally, Bitcoin traded largely within crypto-native exchanges. Its cycles were driven by internal narratives, halving events, adoption metrics, technological upgrades. But once ETFs and institutional vehicles absorbed large supply, flows began dictating movement, flows tied to Wall Street. Now Bitcoin moves on Federal Reserve expectations. It reacts to bond yields. It trades with tech stocks during liquidity cycles. The asset built to escape central bank influence now responds directly to central bank policy. That is not a conspiracy. It is financialization. When an asset becomes large enough, it becomes integrated. Integration brings liquidity, but it also brings correlation. Bitcoin did not lose its decentralized core. It gained systemic linkage. And systemic linkage changes behavior. Consider liquidity cycles. When interest rates are low and capital is abundant, institutional investors increase risk exposure. Bitcoin rallies. When rates rise and liquidity tightens, risk assets fall. Bitcoin falls. It behaves less like an isolated monetary revolution and more like a high beta macro instrument. The cage is not visible. It is structural. Wall Street did not need to control the network. It only needed to control the flows. By creating regulated access points, it positioned itself between capital and Bitcoin. Investors no longer needed to understand wallets or nodes. They needed a brokerage account. Convenience replaced self-custody. Infrastructure replaced rebellion. There's another layer, ownership concentration. Large asset managers now hold significant portions of circulating Bitcoin on behalf of clients. These coins sit in custodial structures. They are technically owned by investors, but operational control is centralized. If large funds experience inflows, Bitcoin surges. If they experience outflows, Bitcoin declines. That dynamic did not exist at scale in the early years. Bitcoin's independence has not been erased, but its price is now deeply influenced by traditional capital allocation decisions. This matters in times of stress. If a liquidity crisis forces funds to sell assets to meet redemptions, Bitcoin becomes part of that selling. It is no longer insulated, it is embedded. Yet there is a paradox. Wall Street's involvement also legitimized Bitcoin. Regulatory clarity improved. Political hostility softened. Institutional research expanded. Governments began discussing strategic reserves. What was once fringe became mainstream. The cage strengthens the asset's survival chances. But it also reshapes its identity. Bitcoin was designed to operate without permission. And now its largest holders operate within the most permissioned financial structures on Earth. Does that mean Bitcoin failed? Or does it mean it evolved? The answer depends on what you believe Bitcoin was meant to be. If it was purely a tool for financial sovereignty, then institutional custody dilutes its spirit. If it was digital hard money competing in global markets, Institutional adoption may be a necessary step toward dominance, but the tension remains. An asset cannot be both fully outside the system and fully integrated within it. Bitcoin now sits in between, still decentralized at the protocol level, increasingly centralized at the liquidity level, still capped at 21 million, increasingly traded as part of global macro portfolios. The cage is not chains, it is correlation. It is dependency on liquidity cycles. It is concentration of custody. It is the transformation from rebellion to allocation. And once an asset becomes allocation, it becomes subject to the rules of capital flows. The real question is not whether Wall Street built a cage. It is whether Bitcoin can break it. Part 2 will examine whether systemic crises ultimately strengthen Bitcoin's independence, or tighten the cage further as regulation, institutional dominance, and financial integration deepen. Because the story is not finished. The cage may be structural, but the protocol remains free, and in financial history, structure and freedom rarely coexist without tension. If Wall Street built a cage around Bitcoin, the real question is whether that cage is permanent. Because systems do not just absorb assets, they reshape them. Bitcoin today is no longer fighting for survival. It is fighting for identity. The protocol remains unchanged. Blocks are still mined roughly every 10 minutes. The supply cap is still fixed. No central authority can inflate it. That foundation is intact. But price is perception. And perception is now mediated by institutions. When Bitcoin trades through exchange-traded funds, custody giants, and regulated derivatives markets, it becomes part of the broader liquidity machine. That machine runs on interest rates, credit expansion, and risk appetite. When liquidity expands, Bitcoin thrives. When liquidity contracts, Bitcoin bleeds. That cycle did not define Bitcoin's earliest years. Back then, its volatility was internal. Today, its volatility is macro, and that changes how crises play out. Imagine a systemic financial shock. If equity markets fall sharply and credit markets tighten, large funds may need to reduce exposure across portfolios. Bitcoin, now classified as a risk asset in many allocations, becomes part of that reduction. Selling pressure emerges not because the network failed, but because liquidity demands it. That is the cage. Bitcoin can be technically sovereign while economically entangled. But here is where the paradox deepens. If the crisis becomes severe enough, if trust in fiat systems erodes, if sovereign debt fears intensify, if currency volatility spikes, Bitcoin could transition from risk asset to safe haven in real time. That shift has not fully happened yet. So far, Bitcoin has mostly traded like high beta technology, but its long-term thesis was never about quarterly liquidity cycles. It was about monetary credibility. If global debt burdens continue expanding and confidence in central bank balance sheets weakens, Bitcoin's fixed supply narrative strengthens. Institutional capital could then rotate not away from it, but toward it, not as speculation, but as protection. In that scenario, Wall Street's infrastructure becomes an accelerant. ETFs allow rapid inflows. Custodians can scale storage. Liquidity channels already exist. The same cage that integrates Bitcoin could amplify its breakout. The key variable is narrative dominance. Is Bitcoin primarily viewed as a speculative tech asset or as digital hard money? Narratives drive allocation. If pension funds classify Bitcoin as volatile growth exposure, it trades with NASDAQ. If they classify it as monetary hedge, it trades with gold. That classification is still evolving. Another layer of the cage is regulatory influence. As Bitcoin integrates deeper into traditional finance, governments gain more leverage over its on-ramps and off-ramps. Exchanges can be regulated, custodians can be supervised, ETFs can face restrictions. The network cannot be shut down easily, but access points can be shaped. Control does not require protocol dominance. It requires gatekeeper influence. If compliance frameworks tighten, surveillance increases, and reporting expands, Bitcoin becomes easier to monitor and track within the system. The asset built for permissionless transfer becomes increasingly routed through permissioned infrastructure. Again, this does not destroy Bitcoin, but it narrows its edges. Then there is concentration risk. Large asset managers now hold significant portions of circulating supply on behalf of clients. While ownership is distributed across shareholders, operational custody is centralized. If a small number of custodians manage a large share of coins, systemic risk shifts. A failure, breach, or regulatory action targeting a major custodian could create volatility. In early Bitcoin history, coins were dispersed among individuals. Now they are aggregated within institutions. Aggregation increases efficiency. It also increases vulnerability. However, it would be simplistic to frame this as purely negative. Institutional integration reduces existential risk. When major financial firms hold billions in Bitcoin exposure, political incentives change. The asset becomes embedded in retirement accounts, corporate balance sheets, and sovereign discussions. Outright bans become harder. Bitcoin transitions from outsider threat to systemic participant. That transition may be exactly what allows it to survive long term. Revolutions often fail. Assimilation often persists. The deeper question, is whether assimilation dilutes purpose. Bitcoin's founding philosophy centered on self-sovereignty. Not your keys, not your coins, was not marketing, it was doctrine. Today, millions of holders have exposure without ever touching a private key. They own claims, not custody. That is convenient. But convenience reintroduces intermediaries. Intermediaries reintroduce counterparty risk. Counterparty risk was what Bitcoin aimed to eliminate. The cage, then, is not walls. It is dependence. Dependence on brokers. Dependence on custodians. Dependence on regulatory stability. Dependence on liquidity providers. Yet the protocol remains indifferent. It does not know who owns the coins. It does not know whether they sit in a cold wallet or a fund structure. It validates blocks the same way, regardless. That indifference is power. Wall Street can dominate flows. It cannot rewrite supply. It cannot inflate issuance. It cannot halt global peer-to-peer transfers without global coordination. And that distinction may ultimately matter more than short-term correlation. If the global financial system enters a prolonged instability phase, rising sovereign defaults, currency fragmentation, geopolitical capital controls, self-custody may regain urgency. In such an environment, holders could migrate coins out of institutional structures and back into private wallets. The cage would loosen. Integration is reversible at the user level. That is Bitcoin's structural advantage. Unlike traditional assets, custody is portable. If confidence in intermediaries weakens, coins can move. The system cannot prevent that without altering Bitcoin's core design, which it does not control. So has Wall Street taken over Bitcoin? It has taken over the liquidity layer. It has embedded Bitcoin into the macro cycle. It has concentrated custody and amplified correlation, but it has not taken over consensus. And consensus defines the rules. The tension between liquidity control and protocol independence will define the next phase. If liquidity dominance dictates long-term behavior, Bitcoin becomes another asset in the global portfolio matrix. If protocol credibility dominates during systemic stress, Bitcoin may transcend the cage. The outcome depends on the next crisis, because in calm cycles, integration feels permanent. In stress cycles, true properties are revealed. Bitcoin was built to escape a rigged system. Wall Street built infrastructure around it. Whether that infrastructure becomes a cage or a launchpad depends on how the system itself evolves. And the system, like Bitcoin, is approaching a stress test of its own.